As I've spoken about before, creating a portfolio on AlphaClone may be easy. The harder part that I find myself and from watching other investors use such platforms is getting people to stick to a strategy. We all think we can outsmart the markets. We all want to do our own research. Joel Greenblatt had a very interesting point when interviewed about the magic formula. Joel Greenblatt had 40% documented investment returns over a 20-year period. He created a modern-day value investing formula based just upon two basic principles. He produces all of his information, puts his research online for free for everybody to have access to. Even wrote a book how to do it. In the interview, they asked Joel. They said, by putting this stuff out there and making it freely available, don't you think that the magic formula over the future will lose its potency since everybody can do it? Won't that opportunity be arbitraged away? And he gave a very insightful answer, and the answer he gave was that he didn't think people could stick to a strategy like this, one that requires turning your brain off and following a rules-based model. AlphaClone provides that type of model. I asked Jadala about that.
That's right. It's fascinating. I mean, there are a lot of behavioral texts I think that are also good kind of to read out there, but it's fascinating that the behavior that you just described is the behavior that is easiest and most people do, and it's exactly the opposite of what you should be doing. And therein is the challenge, right? As a human investor, right? That you need to go a little bit against your own nature in order to succeed.
AlphaClone is the best and probably a myriad of different ways to mimic hedge fund performance. There's some new ETF products out there, I think less than 5, that use some type of hedge fund modeling. Typically, they're not looking at individual portfolio positions like AlphaClone is, then constructing a portfolio around them. They're just using merger arb, long, short. They're using basically hedge fund strategies to recreate sort of a fund that should somehow track hedge fund performance. There are a lot of sites that I call sort of screening 1.0. They're just combing through Edgar, which is the SEC's repository for all this type of information, and then listing holdings. Market Folly is a great blog that takes that maybe a step further. So not only are they is that blog going through, and the blog is run by Jay, who's a hedge fund analyst himself. Not only is that blog sort of going through the filings, but because he's an investor and he understands sort of what may be going on, Jay's trying to provide some type of running commentary behind some of those changes. Jay also just launched a premium newsletter that comes out quarterly. It's excellent work. Check that out as well. And let me know if you have any ways, your own ways that you've devised to track hedge fund performance. In the next part of the show, I wanted to drill down a little bit into the insider trading / expert network issue that's captivating investors around the world. I saw a very interesting poll done on CNBC, and it was quoted by Henry Blodgett at the Business Insider. And in this poll, some 60% of viewers reported the idea of checking with industry insiders to get real-time insights into business trends seems unfair. So we'd like to talk about the investment playing field being level, right? We have Reg FD that came in around 2000 that prohibited preferential disclosure within the investment industry and within corporate America. Essentially that meant, that was the end of the old boys network. So what has happened though in the vacuum that's been left by Reg FD is that the expert network has really become the new old boys network. If we think of exclusive information or the type of information that is harder for individual investors to get, it's very easy for hedge fund investors to actually find an edge. And that's what they get paid for, and that's where the outsized profits are. According to that Stiglitz paper I quoted earlier in the show, that's what hedge funds get paid for, is that informational inefficiency. They are the efficiency insurers. So back when I was at the hedge fund, we used Gerson Lehrman Group, which was and is the largest, the 800-pound gorilla in the expert network field. and I write about this in Tradestream Your Way to Profits. We paid something like $8,000 to $12,000 per month to get 3 different industry, research coverage in 3 different industries. I would basically call up with an information request saying I'd like to research how well, an example I brought in the book is how well Gateway Computer is now selling on the floor of Best Buy. Actually, Gateway wasn't selling on Best Buy. They had actually merged with a company called eMachines. And in turn, I was put in touch with, typically they weren't actually current Best Buy employees, but they were store managers or the electronics department managers who had recently left the company and were doing some consulting on the side. I didn't get any inside information, but the type of color that I could get by knowing sort of what trends are on the floor, what customers were looking for, what was selling well when they left and what wasn't, was extremely invaluable. Now, that's not to say that an individual investor couldn't do the same thing. And I have friends that, when they were investing in Apple, 1,000% ago, would go to Best Buys around the U.S. and talk to store managers and get the same type of information. This is not exclusive information. An expert network just makes it a lot easier to obtain for an investor. So there is an advantage. And Henry Blodgett, in tongue-in-cheek form, really sort of drills down into like why 60% of investors think that this is unfair. What do they think that Wall Street does all day? And to quote, Blodgett says, Wall Street spends tens of billions of dollars a year checking with industry insiders in one way or another. It also spends tens of billions of dollars a year analyzing financial statements that are often inscrutable to folks who don't work in the industry. And it spends tens of billions of dollars building real-time trading systems, locating its computers close to the stock exchange for faster execution, and so on. What does Wall Street spend all this money and go to all this effort? Because it has to. It's the only way it even has a tiny hope of gaining an edge over other investors. As we've often noted, the only way to win in the trading game is to beat other investors. You can get the market return by investing in an index fund. The only reason to trade, therefore, is to try to do better than the market return. And again, the only way to win the trading game is to win while other investors lose. It's somewhat simplified view of trading. It's not a zero-sum game. When a hedge fund gets, outsized returns, it doesn't mean someone else is losing in an outsized manner. Everybody can theoretically win. But obviously, hedge funds get paid, a premium. They typically take 2% on assets plus a 20% performance fee on their profits. And they get paid for doing, they can charge those fees, which are quite hefty if you compare it to an average mutual fund or exchange traded fund, an ETF. They get paid because they can produce, and if they don't produce, the money is not sticky, and the money finds a home that that can produce at that level. So put that in your pipe and smoke it. Expert networks, I think, are here to stay. I can make a case, and I did on the blog, that they are a good thing, even though compliance issues are sticky around these things. They do help the flow of information. James Altucher was on CNBC the other day, and he was pitted against an industry lawyer who was actually pushing for more regulation, as lawyers should. That's sort of their incentive. And Altucher took the whole side that we really shouldn't have, we should completely relax our insider trading laws. And it made good conversation. And there are cases, and I point to some of these papers on my blog where it may make sense to relax some of the insider trading laws. Typically, having some type of structure protects your individual investor from stocks being manipulated by insiders, and from insiders sort of raiding the corporate cookie jar. But ultimately, expert networks are a efficient way to transfer information among people. They're not exclusive in the sense that they're capturing information that is inaccessible to other people. It just makes it easier, and we'll see how this plays out.